3, start.
Can I start? Good afternoon, all of you. Yes, I hope all of you. Good afternoon.
Good afternoon. How are you?
Yeah, I'm doing fine, ma'am. How are you?
Good, thank you. We are fine too.
Yeah, thank you. Yeah. Good afternoon, all of you. I, Dr. Triveni, I welcome you for the Ramaya webinar series. Ramaya Institute of Management is having a series of webinar, and one of the topics that has been chosen today is finance for non-finance executives. I'm sure this topic would be of great interest to many of you, and also it's of interest to me because I teach finance, and finance is very close to my heart, and that's how I chose this topic. And today we'll be discussing about what is the role of a non-finance in an organization as well. To begin my session, I would like to start my session with a question. I hope I'll get some answers from all of you. Stop moving. Who is a finance person according to you? Can I get some answers? The time is very odd in the day today, and my session will be more interactive, so I want you all to be participating. My question to you is, who is a finance person? Yeah. And there is another question attached with this. What do you think is a finance person's job? Can I get some answers? Yes, Pawan, good afternoon. Prachi, good afternoon. My question again, I repeat, who is a finance person according to you? And what do you think is finance person's job? Everyone in the organization? Yes. Cost controller? I'm getting few answers. That's nice. Okay, normally when I ask this question to corporates or to students, the kind of answers that I get is this: one who manages finance, one who takes care of the accounts of the business or manages the financial activities in a business, is what is the answer that I get. Let us look at the answers that I've been getting. When I ask about this question in the class, normally they say a person who tracks the financial activities in a business, or one who collects and records the financial data. I also get an answer which says person who collates and presents the financial data in a form of financial statement is a finance person. Do you agree with the term calling him as finance person? Do you think a finance person will be doing all this job? According to me, it is an accounts person's job. It is an accounts person who needs to know how to close his financial statements, and it's not a finance person's job. Accounts person will have to look at the business details, the financial transaction details. He has to collect the details, he has to record the details, and he has to look at collating all the details and preparing the financial statement. It is not a job of a finance person. Okay, so now we will look at understanding who is a finance person. According to me, I have a different perception, but can I get some answers from you? There is one more answer which says anybody who deals with money is a finance person. That's a good answer. But when we look at a corporate or an executive world, who do you think in a corporate is a finance person? Yeah. One who takes strategic decision. Okay. I'm getting good answers from everybody. One who projects finance. Okay. One Mr. Prasad is here. He's telling one who takes care of financial aspects related to the business. Okay, now let's look at some of the understanding of this. To understand about who is a finance person, I'm introducing you to two important topics in business, or two important terms in business. One term that I would like to refer to is top line of a business and bottom line of a business. What do you think is the bottom line of a business? What do you think is the bottom line of a business? Can anybody answer this? Yes. Okay. I'm getting right answers. Profit, net profit, sales, capital investment. Okay, there are few answers which are coming up. Let's understand what is this top line and bottom line in a business. In a business, we find profit and loss account. When we look at profit and loss account, we will have sales, and this sales is nothing but the top line of a business. We have net profit, which talks about the bottom line of a business. And no business will have bottom line without the top line. Hence, top line is a very important thing in any business. And every business definitely focuses on getting top line, but their ultimate goal would be at having a positive bottom line. So my discussion today would be revolving around what is this bottom line of a business and what is the role of individuals in the business and how do they contribute towards the bottom line. So now we will understand who exactly is a finance person. Any person in an organization whose job has a financial implication is a finance person. Any kind of job he's doing, and his job definitely will have certain financial implications, and all those people who are in this kind of activities are known as finance person. For example, if I have to talk about, say, a salesperson, we will look at that example a little later. Let us understand something more. Every individual in a business will have to understand that whatever activities he's doing will have an impact on the bottom line. So what is the impact of his job on the business has to be understood, or in other terms, what is the impact of his job on the bottom line has to be clearly understood by each individual in a business. Hence, every employee should know about finance because his activities indirectly will be having an implications on the bottom line of business. So now we will be looking at the activities or business activities mainly which we look at. There is something. Okay, for example, a salesperson. When we talk to a salesperson, he says his main activity is to sell. And when he is selling, he will be dealing with three important terms. So if you look at that, he'll be talking about the price of the goods or the finished products, whichever he's selling. He'll be talking about the price. He will have to know about the quantity that he has to sell, or he has to know whether the sales can be on cash basis or it can be on the credit basis. And all his decisions that he takes about his sales activity indirectly contributes towards the bottom line. So what is this bottom line then? What is this activity of a sales? Do you think it's a sales decision, or do you think it is a finance decision that he is making? If you ask a salesperson, he will say it is only a sales decision. But when we look at it in detail, we understand that though the person is doing sales, all his decision is based around finance. And the decision that he makes has an impact on the bottom line. Definitely it will contribute towards the bottom line. So we have to understand that every business activity has an implication on bottom line, and any personnel working in various departments will be contributing towards the bottom line of a business. Another example that I'm talking about is purchase department. A purchase department will be looking at buying raw materials or goods that is required for the production activity. And when he has to buy, the purchase manager or the purchase executive, when he has to buy, he has to know the price at which he's buying the raw material. He has to know what is the quantity that he has to buy for the production activity, or what is the kind of credit he can avail from the supplier, or if he is ready to pay the cash, whether it should be a cash purchase. And when it's a cash purchase, he'll know what is the kind of discount he'll be getting. All these decisions that he'll be making with regards to the price, the quantity, the credit aspect, or the discount aspect, in turn has an implication on the bottom line. Okay, hence, though the purchase department says it's a purchase activity, it's not a finance activity, you have to understand the decision making process which goes in is finance based. It is not exactly purchase based. It is indirectly having an impact on the bottom line. Hence, every individual in an organization contributes towards the bottom line of the business. So we have to understand that every organization will have to know, or every individual working in an organization will have to know what are the finance aspects that is there in a business. Now, to understand this, I have a small picture which I'll be putting up now. This picture will be showing you about the office. You please watch out this image. You can see people working in an office, and you can also find people working very seriously. You can see people having discussion. Looking at this image, can you tell me what is the performance of this company, or how is this company positioned itself? Can you tell me what do you think is the company's performance? Can you guess the performance? I'm waiting for some answers. Can I get some answers? Yeah. Do you think the performance is too good? Okay, there is an answer here. Very good. Okay, somebody is telling firefighting. Okay, any other answer? Highly performing. Okay, people are exhibiting professional behavior. Okay, we cannot guess correctly. Okay, somebody is telling we cannot guess correctly. Yes, fine. Absolutely right. I want to tell this that some of the answers says guessing is difficult. Yes, I'm sure looking at this picture, you'll not be able to judge how the company's performance is. To know about the company's performance, it is very important to know what is it that the company is earned, or what are the expenses of the company. In other words, we have to look at the profit and loss account, and we have to look at the profit and loss account, or the income statement, or the income and expenditure statement, to understand the performance of the company, which is like a videograph. It is like a video of the company from one point of time to a defined period of time. It may be for a period of year, or half yearly, or quarterly, or monthly. So normally profit and loss account is prepared for a given period of time. Okay. And just by looking at the profit or loss, or the earnings and the expenses, we are not able to conclude whether the company is performing well. We should also know how the company is positioned itself. And how do we know the company's position? And how do we get to implement this in understanding the financial performance or the performance of the company? Actually, the balance sheet, exactly when we look at, tells us or helps to know how the company is positioned at any given point of time. So a balance sheet is also known as statement of financial position. A balance sheet helps an individual to understand how is the company positioned at a given point of time. Hence, it is called as a snapshot of a business. If you look at other aspects, we talk about something known as liquidity. What is this liquidity? Liquidity is nothing but the cash inflows or the cash outflows. In other words, how much cash does a company have in its kitty? Does it have enough cash to manage its day-to-day expenses or the day-to-day business activity is what we look at. And this is shown to us through a cash flow statement. A cash flow statement helps us to understand what is the cash level that is maintained in the business. And post-COVID, my dear friends, majority of the companies, let it be MSMEs or the bigger companies or any kind of industry, has faced a major problem in this liquidity matter. Every company is going through issues in liquidity. and every company is trying to manage its liquidity position. I'm sure many of them, whoever who is doing business, who have logged in here, will definitely agree with me, because every company is having financial crunch, and this is the major problem that they are facing. So to understand the performance of a company, we need to know the financial statement of a company, or we need to look into the financial statement of a company. That is what this session today is focused at. The session today is focused at understanding what are the various financial statements that we get to see in a company. I'm sure many of you would have been reading newspapers, and you keep seeing the annual balance sheets of various companies which will be published in the newspaper. Why do you think companies are publishing this? It is nothing but to inform the people about its performance, about its position, or about its liquidity position. So that is the exact reason why we see all this financial data coming up in the newspaper. Now we will understand what exactly are these financial statements. Of course, financial statements is a very vast subject to understand. And the accounting or the financial statements is actually prepared by an accounts person. Then you may be thinking, as a non-finance person, what is the need for us to understand these financial statements? There is one statement that I would like to make, or one example that I would like to give here. If you look into an aircraft, you have the cockpit, and in the cockpit we have various instruments. Okay, we have various instruments or equipments, and the pilot must know how to operate with all those instruments. If he doesn't know how to operate, because he is moving at a very high altitude with lot of pressure outside, if he's not aware about controlling the instruments there, then you can know what happens to the passengers who are traveling in the aircraft. I'm sure now the aircraft travel is limited, but people who are going or who have been going, you will know what will be the difficulty if he doesn't know how to operate the instruments in the cockpit. Similar situation is what we look at in an organization. An MD sitting in the cockpit will have to know what are the various financial instruments that is there in the organization. The financial instruments, when I talk about, is nothing but the financial statements. All these financial statements should be clearly understood by a managing director of a company. If a managing director cannot read the financial statements, then I'm 100% sure that the company will crash very fast. That is exactly what I want to highlight here. No matter whether you are a finance person or a marketing person or an operations person or an HR person, definitely every individual will be aiming at becoming a CEO or will be aiming at becoming a managing director. I'm 100% sure many of my students or many of the participants here definitely would like to get into a position like that. When you are liking to get into a position like that, you have to understand what are the financial statements. And it's not necessary that you should know how to prepare the financial statements, but you should know how to read the financial statements. So my session today focuses on understanding what are these three important financial statements or the financial statements that we have in an organization. Just as covered in the previous slide, to understand the performance, the position, and the liquidity, we have to know about the various financial statements. Now, looking at these financial statements, as I said, performance is measured to profit and loss account. What is this profit and loss account? Or what do you think is a profit and loss account in an organization? A profit and loss statement is nothing but a financial report that provides a summary of a company's revenues or expenses and tells us in a summarized way whether the company is making profit or loss over a given period of time. So whenever we look at a profit and loss account heading, if you read, it is prepared for a given period of time. Whereas when you look at a balance sheet, it is said as on this particular date. Okay. And also you have to know a company's statement of profit and loss is portrayed over a period of time. The time here may be a month, a quarter, or a financial year or a fiscal year. So that's how a profit and loss account is projected. Now we will look at something very important, that is what are the items that is projected in a profit and loss account. Initially, when we look at, as you all aware, sales becomes the main source of revenue for every business. So we have to understand what are the sales that is made in an organization. So when I say sales revenue in a company is the revenue from the sales activity. When a company is purely focusing on services, we talk about the revenues that is earned through services. So sales becomes the top line in a profit and loss account. That is why the term top line was used. So without a top line, you cannot have the bottom line. Hence, every organization will be focusing on increasing their top line, which will contribute towards the bottom line. Of course, if you only focus on increasing the top line, it will not help you at all, because you have to see how do you manage with your cost of goods sold. When I say cost of goods sold, what is it that we refer to here? Can I get some answer? What do you think is the cost of goods sold? Opening stock plus purchases, okay. Anything else? Any other answer? Yeah. Selling cost? Okay. Cost of material? Yes. Anything else? Okay. So this is nothing but the actual cost or the direct cost of production in an organization. Okay. When we refer to a sales based organization, we talk about cost of production or cost of sales. So all the direct cost which is involved in manufacturing the goods and all those costs which is involved in getting the goods to a finished goods state is called as the cost of sales. Whereas in a service organization, we look at only the service based. The production activity is not considered over here. It will be the cost involved in providing the services. So we take the revenue. From the revenue, we exclude the cost of goods sold. We also exclude various selling and general and administrative expenses. Whatever expenses with regards to selling, general and administrative expenses are related, all these items will be excluded from the revenue. The marketing expenses, marketing or promotion based or advertising based expenses will have to be excluded from the revenue. And any expenses relating to interest. What is this interest? Interest, any guess? What is interest? Can anybody guess what are the interest? What do you think is the interest expense in an organization? Yeah, it is the expense which is incurred because of some borrowings in an organization. Any borrowing of an organization is not free of cost. It is the cost of borrowing exactly. So the borrowing is at a cost, and that cost that is paid back to the lenders is known as the interest. So we look at the interest expense as well. We exclude it from the sales revenue. After we exclude this, we are left out with earnings before the tax. And what we do next is we exclude the tax expense. Every organization, every business will have to pay for the taxes because of the revenues that they are making. So the tax expenses is excluded, and then we arrive at the net income. That is nothing but the profit or loss of a company. This image is just to make it simple for you to understand what exactly is the profit or loss. In a simple way, if the earnings of a business is high than the expenses, the company is making profit. You can look at this image. If the earnings is higher than the expenses, the company is making profit. Whereas if you find the expenses are higher than the income, then the company is making a loss. So this is in nutshell, what a profit and loss account is going to help a person to understand about. An outsider, when they are looking into a profit and loss account, he will normally look at the end, the bottom line, to understand whether the company is making profit or whether it is making loss. And it's very important that you have to look at this profit and loss in detail, because this will be talking about the performance of a company. So now that you were looking at the image which I showed earlier, with the image, it's not clear to judge whether the company is performing good or whether it's having some issues. Somebody said they are working very professionally. No matter what the company's vision statement is, what the company's mission statement is, it may have attractive vision and mission statement. Until and unless its bottom line is not strong, company will not be considered as performing well. Normally, we read the company's vision, mission statement and conclude, oh, this company is focusing at a very higher end. But only when we look at the profit and loss account and at the bottom line, we will understand whether the company is performing well or not. So this is about the profit and loss account. Normally, profit and loss account is projected in different formats. I am projecting or I'm showing you some of the formats for your references. The profit and loss account, if you see here, this is a normal T format, which has expenses listed on one side and the revenues listed on the other side. If you look at this, this is the typical profit and loss account, which any company will be following. But of late, the formats have changed. The format that is being used now is a vertical format, which I'll be showing you slowly. Look at this profit and loss account. Here we take the sales, we look at the direct expenses and arrive at the gross profit. You can look at the gross profit that is arrived at here after excluding the direct expenses. Then we take the gross profit. From the gross profit, we exclude all other expenses that the company has incurred. After we exclude all the expenses, what we arrive at is known as the net profit. Another format which is presented here for you is something known as income statement. This income statement will have all the revenues listed initially, okay? Then we look at the cost of goods sold, that is nothing but the direct cost that is involved for manufacturing the goods. And then we will have other expenses, whatever are there will be excluded and we arrive at the earnings before tax. After we arrive at the earnings before tax, we also look at the tax expense and then we come to the net income. Of course, interest is also there. Interest expense is also considered and then we arrive at the net income. Yes. Now we look at another format which is known as income and expenditure statement. Looking at the income and expenditure statement, the statement is very clear here. All the income of the organization, all the income of the organization is shown in one side and all the expenditures is shown on the other side. And what we arrive after excluding the expenses is known as the income over expenditure. That is what was shown to you in the image earlier. These are the formats of income and expenditure statement. Now going ahead, the next important statement which will help us to know the position of a company is a balance sheet. What do you think is a balance sheet? Can I get some answer? What do you think is a balance sheet of a company? I would like to get some answers from you. I hope all of you are there. Good afternoon. Assets and liability statement. Okay, Prachi. Any other answers? Oh, it's talking about the financial position. Okay. Fine, I'm getting a lot of answers. Good. Let's look at what exactly is a balance sheet. A balance sheet is a statement, is a financial statement which displays the company's assets, liabilities, and shareholders' equity. And this statement is commonly known as assets must be equal to liabilities plus equity, which is also known as accounting equation, which will follow in my next slide. Next, we talk about this statement is prepared or is collated mainly to show the financial position of a business. So a balance sheet is a very important tool which helps us to understand at a given point of time what is the position of the company. In other words, we talk about a balance sheet being a snapshot for a given point of time. It's like a camera. It is expressed as a snapshot or a financial picture of a company at a specified point. Okay, and then Kiran, it's not moving. We look at the next thing. Balance sheet has three important sections in it, that is assets, liabilities, and shareholders' equity. If you look at this, I will be spending very little time on this, but I want to spend some time on this. You have to understand what is assets, what is liabilities, and what is the owner's equity, which is projected in the balance sheet. Look at this aspect, liabilities and owner's equity here. Liability and owner's equity are the sources from which business is getting funds. Okay, every business gets funds for starting its activity or to carry on its activity. What are the main sources from which the business gets funds is listed here, is projected here. Owner's equity is nothing but an owner who is lending money for the business. Liability is the money that is borrowed from financial institutions or banks or friends or anybody as such. This two, liabilities and owner's equity, is known as the sources of fund. So here you should look at this owner's investment. When we say owner's investment, any person who is contributing, he is not contributing free of cost, but he will be expecting some returns. He is the owner of a business, but he wants the returns. And amounts owed to the creditors is listed under liability. With this source of fund, this fund which is borrowed or which is gathered as capital is used. And this assets talks about the usage of the fund. Where are we using these funds? These funds are used to buy items for the business. It can be land. If you want a land for your business, you need fund. And that fund comes from the liabilities and the owner's equity. With that, we buy the assets of the business. It can be the land that is bought for the business. It can be the machinery that is bought for the business, or it can be the car or any other vehicles that is required, equipments that is required for business. These are the items that are projected under assets. And it's always important, the total source of fund that you have is the fund that you can use. That is why the accounting equation, assets is equals to liabilities plus owner's equity. So always remember, if the assets purchased is higher than the liabilities and owner's equity, that means there is something wrong in the accounting. It doesn't mean that there is something wrong in the fund that is borrowed or the total of the funds that is borrowed and the expenditures. So you have to be very careful when you're looking at a balance sheet, because balance sheet exactly tells us what is the actual fund that the company is having, what are the various sources from which the company has borrowed and the fund that the company is having, and what is the investment that it has made or where all these resources have been utilized. That is what is projected in this balance sheet. Hence, it is very important for you to judge a company's performance based on looking at the financial position of a company, that is the balance sheet. Now, we will look at how a balance sheet is actually structured. In the corporate world, we find very different organizations will have different forms of maintaining their statements. But you should be very clear that like all financial statements will have minor differences. They may have some format, but there will be some minor differences between organizations and industries, but all will have to follow one common way of maintaining these records. Actually, when I was planning for the session, I was looking at so many terminologies which I wanted to include here. But for the time constraints, I'm just looking at basic concepts, which is very important for a finance person in an organization to understand the financial position of the company, so that he will understand how his roles in the organization plays a major impact on the bottom line of an organization, of the company. Now we look at, there are few of the terms that you have to be aware about. What are the items that comes in the balance sheet? You look at this. There are commonly found buckets or several buckets and line items that are found in a balance sheet. We talk about a few of this. For example, we talk about current assets. When we deal with it in detail, we will be going into the depth of what a current asset is. Normally, a current asset, just to give you a brief about it, current asset is held in an organization for a period of 1 year and not for a period beyond a year. Anything which is held for a period beyond a year is categorized under long-term assets. We look at current liabilities. Any borrowing which is made for a period of a year is known as current liability. Any borrowing which is made beyond a period of a year comes under long-term liabilities. And equity as such is nothing but the owner's contribution or owner's investment in a business. So in a balance sheet, if you look at anybody, see, this session is to help out people who are not from accounting background to know how to look at a balance sheet or how to read a balance sheet. So when you look at a balance sheet, you should be looking out for terms like this: long-term assets, current liabilities, or long-term liabilities. You will be able to look at all these terms in the balance sheet, and you should be able to understand the word current means for a shorter duration. The word long means for a long term. So this will help a person to evaluate what are the borrowings of the company and how the company is managing its finances. Now we look at the formats of balance sheet. Normally, when I talk about a balance sheet, there are two different formats that we find. One is the horizontal format and the other one is the vertical format. I will be spending some time here. Look at the horizontal format of a balance sheet. And I'm also trying to emphasize few of the assets that you find in a balance sheet through this image here. Look at this. Under the borrowings, which is called as liability, we have capital. Capital is nothing but the owner's equity. I have been projecting a sole traders business format of balance sheet here. I have not projected a company's format that comes in the vertical format. In the next format, I'll be explaining. Any individual who is contributing towards the capital, that is the owner, that money, whatever is contributed, will be shown here as capital. Okay. And any profit which is retained in the business over a period of time for future use or for diversification plan is shown as reserves and surpluses. Any expenses which is yet to be paid by the company, which is known as outstanding expense, is also shown as liability. Any borrowings from a bank or financial institution is known as the loans of the organization. So that is projected here. Then we look at short-term borrowings. For example, trade creditors. That is, suppose you buy raw materials from a supplier and you promise to pay him at a later date within a span of a year, that person comes in a category known as trade creditor, or a person who is lending money for a shorter duration for the business. Then we talk about bills payable, similar to that of purchase activity. So these are the terms which we look at under liabilities. When we look at an asset, normally the sources of funds will help an organization to buy the assets for the business. So this fund, what is available, with this fund, the company will buy the land and building which is required for the business to operate, plant and machinery for its manufacturing activity, furniture for its day-to-day activity, the inventory or the stock, which is highlighted here, for its manufacturing or processing activity. Then we look at sundry debtors, bills receivable, or miscellaneous investments and cash, which comes under current assets. So these are all the assets which is termed under current assets, which are held by the business for a shorter duration. This is how a balance sheet is projected in a T format. This is a sample format wherein for a sole trading concern, normally they follow this format. But in practice of late, we find vertical format of a balance sheet which is projected. In the vertical format, we look at how the funds have been utilized first. That is, what are the various sources where the funds have been used. Here we look at non-current assets and current assets. The term non-current asset talks about the fixed assets or the assets which is held for a longer term of period. So here you can look at land and building, the furniture, the machinery, investment. I will quickly flip to the previous image so that you can relate it. See here, land and building, plant and machinery, furniture, all these items I was talking about comes under long-term assets. Same thing is shown here as non-current assets. Under the non-current assets, we normally have land and building, furniture, machinery, investments, or any leased goods or any asset that is bought on lease. Then we look at current assets. Current assets normally includes the inventory or the stock, debtors, bank, and any cash balances that the company has. And this is held for a period for not more than 365 days in an organization. I have just given you an example here so that you will get an idea. The total of the current assets is projected together as non-current assets. The total of the current assets is shown in the outer column of the balance sheet as total of the current assets. And both the non-current asset and the asset together gives us the total assets of a company. Looking at the next aspect, that is the sources of finance, which is actually projected at the end, we look at equity and liability. When I say equity, it is the owner's contribution, whatever owner has invested in the business or owner's equity, we call it as capital. That is shown here. And the borrowings the company is made, which is known as long-term borrowings or non-current liabilities. So here you find a loan of 10%, which is borrowed by the company. And we also have current liabilities, which is projected here. Current liabilities are the short-term liabilities of an organization. All this put together tells us what are the total equity and liability of the organization. That is how a vertical format of an organization's balance sheet is projected. Of late, the practice is to present the financial data in a vertical format, be it a P&L account, the profit and loss account, or a balance sheet, all are projected in a vertical format. Now coming to the next important statement is the cash flow statement. As I was discussing earlier, liquidity. Liquidity of an organization is very, very crucial. Every organization will try to have a sound liquidity position of it. Why is liquidity very important? We have to know this in detail. Any participants who can tell me what is the need for company to be liquid always, or why should a company maintain a good liquidity position? Can I get some answers? Why do you think a company should maintain liquidity in it? To handle day-to-day business, okay? To pay current obligations, to meet day-to-day expenses, yes. Not only to meet the day-to-day expenses, and it shows the position, it shows how good the company is managing its finances. If a company is not able to manage its day-to-day financial activity, that shows the company is having some major hitch in it. So it's very important that a company should look at having a good liquidity position all through its tenure. How can we evaluate the liquidity position? A cash flow statement helps us to understand what is the liquidity position of the company. What does a cash flow statement talk about? So look at this. It shows the increases in the cash or the decreases in the cash that the company is having over a period of time. What are the increases or what are the cash inflows, in other words, or the cash outflows of an organization? And it is normally expressed over a period of time or for an accounting period. Normally, cash flow is prepared for a period of a year, or it can be prepared for a quarter or year-to-date basis. So cash flow statement is very important for an organization because it will help us to understand what are the various cash that the company is getting because of its operations, or how is the cash using, or how is the company using its cash for its investment activities. When I say investing activities, where are the funds being utilized? The cash of the company. When I say fund here, I'm referring to the cash. Where is the company investing its cash? It has to be aware of it. And what are the sources of finance for the company from where cash is coming? So these are the three important sections that you find in a cash flow statement. Cash flow statement shows the net change in the cash balance from start to end of the period. What is the start of, from the starting point of the business? Say for example, if you are having an accounting period from 1st April till 31st March, so what was the cash on the 1st of the April and what is the cash at the end of the period, that is 31st March, is to be evaluated. And the cash, the real cash inflows and outflows is projected in the cash flow statement. And when we look at the cash flow statement, it is very important. Look at what I'm highlighting here. The cash from operations. What are the cash from operations has to be looked into in detail, because the major cash activity in an organization is happening in this quadrant of cash from operations. Hence, it's very important for all of us to evaluate the cash from operations. Now, looking at the format of a cash flow, my dear friends, if I start talking about cash flow statement in detail, it takes us together to understand the cash flow statement, the preparation of cash flow statement, or to know how a cash flow statement is worked upon. Hence, I'm just showing you a format here to understand how cash flow statement is shown. Look at this. I was talking to you about cash flow from operation or operating activity. Normally here, we look at the day-to-day business activity, that is cash receipts that is coming from the customers, or whatever cash is paid to suppliers and employees. All those things are projected in the cash from operating activities. We also look at some of the other cash related items like interest received, interest paid, dividend received, and dividend paid. Then we look at what is the normal tax paid, the secondary tax on companies paid. All these items are included, and then we arrive at the net cash inflow from operating activities. Preparing the operating activities cash flow itself is a major task for accounting persons. They look at it in detail and they work on it because they should be sure about excluding all the non-cash items from the operating activities. I am not going into these terms about non-cash items now because of the time constraint, but operating activities is a very important source of cash flow which has to be looked in detail before we come to a conclusion about the cash flow statement. Okay. Next, we talk about cash flow from investing activities. Here we look at acquisition of an investment, or investment may be in the form of an asset that is bought, purchase of non-current assets. Acquisition of an investment is where you are buying in some shares or investing in some marketable securities for a longer term. All these items comes here. Replacement of non-current assets, addition of non-current assets, addition to non-current assets, any sale of the fixed assets, any process that we receive will be shown here in the investing activity. Then we look at the financing activity, wherein we talk about what are the capital amount that is received in the form of cash during the year, in the form of share capital that the company is receiving is shown as a cash flow. And if any of the borrowings is repaid, that will be shown here as long-term borrowings. That is, any long-term borrowings which we are repaying, or any expenses that is met towards the financing activity comes up here. That is expenses in the sense repayment or redemption. All those things are shown in the cash flow from financing activity. And after we look at each individual activity, that is operating activity, investing activity, what we arrive at is whether there is any net increase or decrease in the cash and cash equivalents is to be looked into. So we look at that difference and then look at the opening balance, and the closing balance that we get, the difference amount that we get should be equal to the actual cash what is available by the business in hand. That is what is a cash flow statement. I'm sure until unless you have a hands-on experience on preparing a cash flow statement, it is difficult to grasp this cash flow statement through theoretical approach. Okay. So this is about cash flow statement. I quickly will be running through a video which will help you to understand what are these three financial statements.
To determine whether you should, for example, invest in a company or buy its corporate bonds, you can analyze its financial statements. There are three important financial statements which complement each other. 1. The balance sheet, which is kind of like a photo of a company at a certain point in time. It tells you at that point in time what assets such as cash in the bank, inventory, or real estate that company has, and what liabilities it has, such as, for example, debt to suppliers. Subtract the liabilities from the assets, and you'll have the net worth of the company at that point in time, also called equity. 2. The income statement, also called the profit and loss statement, does exactly what its name suggests. It gives you a summary of the revenue and expenses generated by a company over the reporting period. 3. The cash flow statement also has an intuitive name and tells us how much actual cash and cash equivalents entered and left the company over the reporting period. If, for example, the management reports considerably higher profits, but there hasn't been that much of a net cash flow increase, you as an investor have valid reasons to be a bit skeptical. So, as a short recap, the balance sheet helps you determine the net worth of a company. The income statement shows you how profitable it is, and the cash flow statements tells you things such as whether or not the profit numbers are believable.
Yeah. Thank you. So that's the video that you have. With this actually, I'm coming to the end of the session. But before I end my session, there are various terminologies which every finance person of an organization should be knowing. For example, we talk about costing, we talk about management accounting, or we talk about ratio analysis or financial statement analysis. All these things are very important for every individual to be aware of in an organization. But with this time constraint, I'm just sticking on to this financial statements. I will just have a quick check about what is your understanding of all these things. Okay, whatever we have discussed, we'll look at this. What are the financial statements that we have discussed till now? Can somebody tell me the answer? I'm sure you all have understood what we have discussed. The chat box is not on. Yeah. Okay, profit and loss account. You have to include all the three. Yes, that's good. Okay, so we have the profit and loss account statement, and we have the balance sheet, the cash flow statement. All these things forms the financial statements. Of course, of late we have something known as statement of equity, which is also included. Okay, changes in the equity statement also is included, but I'm not discussing about it as of now. Then, what is profit and loss account known as? What are the other terms for profit and loss account, which I've been talking to you? I've been showing you as a format as well. Yeah. Profit, income statement, income and expenditure statement. Yes. So all those are the other forms of profit and loss account in which it is prepared. Yes, that's good. I'm seeing a lot of answers coming in. All of you have been participating. Very nice. Yes. Now, my final question to you. What are the two balance sheet formats that we see? What are the two balance sheet formats that we see? Vertical format and horizontal format. Okay. Yes, that's true. Good. Now, the key takeaways of this session as such to talk to you about is, we were talking about what are the three important financial statements. Okay. I will tell you, I don't want this. Yeah. I just want to summarize the session again. Every individual who is working in an organization will be contributing towards the organization's bottom line. Hence, it is very important for everybody to understand what are the various financial terms that is existing in the market or in the business. And you have to be aware about how to read a balance sheet, or how to look at a profit and loss account, or how to understand a cash flow statement. No matter whether you are from sales department, no matter whether you are from production department or operations department, it is very, very important for you to understand the three important financial statements of an organization, or it is necessary for you to read the financial statement. Even you being in HR department, if you feel you are in a HR department, you may not be calculating the profit and loss account, or you'll not be working on the accounting part of it. But it is important for you to know how to read a balance sheet and how to know whether the company is making profit or loss. Because with this understanding, you will be able to judge what is your contribution to the organization. Hence, today we learned about profit and loss account, which is nothing but a video of a company, a videograph of a company, which is shown from one point of time to a given point of time. That is for a duration of a year or a month or half year or quarter year. A balance sheet is like a snapshot of the company, which will talk about the position of a company at a given point of time. Cash flow statement helps us to understand the liquidity position of the company, because liquidity position helps us to know whether the company has sufficient fund to manage its day-to-day activity. Hence, it's important that every individual should know all these three important financial statements and its importance in understanding the financial performance. Now, quickly, I will just go back to my previous slide. I'll go back to my previous slide. Can I not move? Just once, we will look at this. The image. Now, if I project the same image in front of you, can you tell me how the company is performing by looking at the image? Yes, just look at this image and tell me how the company is performing. Yes, can you guess? No, exactly. So it's very important for you all to understand that understanding about the company's performance cannot be looking at the office or cannot be judged based on the vision statement or the mission statement. It can be understood only by looking into the three important financial statements or the financial statements of an organization. Even if you are a non-finance, a doctor, or you belong to any other streams of your choice, you should be aware about what are the three important financial statements of an organization, which will help you to understand how a company is performing. With this, I end my session. I am now ready for your questions. If there are any questions, I am ready for it. Yes. I am open for questions. Yes. Can I see somebody? Which book I can refer for balance sheet? Better understanding. Okay, there is a question. How to compare financial performance of two companies? Here we use something known as ratio analysis, that is financial statement analysis, which is a different session, which will be covered by one of my colleagues. Professor Kumuda will be talking about how to study or how to analyze a financial statement. There you will get to know how to compare between two statements. Yeah. Yeah, what is the question?
Can I ask a question,
Yes,
Triveni?
Yes, ma'am.
Yeah. How would you evaluate intellectual property of a company?
IP.
And I know, yeah, IP, yeah.
IP comes under intangible asset, ma'am. When we
Okay.
talk about intellectual property, it comes under intangible asset, and the valuation of intangible asset is a different ballgame altogether. So we have to have a different session about understanding how intangible assets are valued. In fact, when we
Okay.
talk about corporate valuation, there we have an exclusive area or a section where we talk about valuation of intangible assets. Under this, we talk about intellectual property as well.
Okay, then I'll meet you separately and have a word with you on this.
Sure, ma'am, sure. Yeah.
Thank you. Lovely session, Triveni. Wonderful.
Thank you, ma'am. Thank you. Yeah. Any other question? Will there be any session on ratio analysis and other topics? Yes, there is a session on financial statement analysis, which will be taken by one of my colleague, Professor Kumuda. Dr. Kumuda, she'll be talking about it. Okay. Reference textbook for beginners, I would recommend you to read one Professor Anil Lamba's book, Romancing with Your Balance Sheet. Please read this book. It is really wonderful. I was also referring that book, and it is very easy to understand. A layman who is not from finance background can easily understand by reading Anil Lamba's book. Please do read Anil Lamba's book. I'm not here to promote him. I just follow few of his videos, so I find it very interesting and easy for people to understand. Talking about the textbooks, if you say, I would recommend you to go through Professor Narayan Swami's textbook. Professor Narayan Swami from IIM Bangalore. His book on financial accounting will help you to understand what it is. There is a question where employees' value are shown in balance sheet as they are the important factor in the companies. Okay, HR accounting. This is something relating with HR accounting. So this aspects have been discussed in various accounting balance sheets as well. That's considered under HR accounting, but I'm not touching on this in this session as of now. HR accounting is done. Provided you get in touch with me, I can explain to you in detail. Pallavi, yes. PDF of basic financial aspects. Yes, we can share that with you. Okay, sharing, I will share the soft copy of the PPT, okay? Why vertical format of profit and loss account is introduced? That is as per the accounting rules. The accounting gap has introduced this vertical format, and there is a schedule 3 format. Okay, somebody is asking, let me answer this. Vertical format is because this is the format which is now in practice, and every organization is following this as per schedule 3 of the Companies Act. There is somebody who's asking, why have you not spoken about fund flow statement? I am highlighting about 3 important financial statements in this session, and this session covers only on this 3 important financial statement, which is profit and loss account, balance sheet, and cash flow statement. Fund flow statement is a different thing wherein we talk about working capital management. I have not touched on this. Yes. Okay. What are the key aspects to be considered to make profit in business? You have to reduce your expenses. Then you can definitely make profits. Yeah. Any online courses? There are many courses. You can log into Coursera and Udemy, which has a lot of courses. You can look at that. Okay, good presentation. Thank you. Okay. What is the difference between fund flow statement and income statement? Fund flow statement talks about the funds of the organization. Income statement is focusing on the expenses and the profit and loss account. Profits of the company, the incomes that is coming in the business. Udemy and Coursera has plenty. Okay, Sai Akhil. You can look into Professor Raja, CA Raja's course. I think that is in Udemy, which is quite good, quite informative. Okay. Okay. What is operating income? That is talking about the income that is after excluding all the operational expenses. That is, we are looking at the earnings before interest and tax. Yeah. I have not touched on those terminologies, EBIT, EIT. Yeah. This is Gurneet Kaur. Yeah. Any other questions? Thanks. Okay, can we close the session? I think we can close the session. We can end the session. My details are available here. If you have further questions, please get in touch with me. The mobile number as well as the email ID is available. Can make a note of this, and you can write to me in separate or in an individual mail. Feedback link will be provided by the team. Okay? Yes. Thanks.